Talking about the mid-caps, it's a good quarterly performance from Justdial in Q1. It's the fourth straight quarter of a 30% plus growth for the company. Abhishek Bansal, who's the CFO of Justdial, joins us now. Abhishek, thanks a lot for joining us. It's been a good quarter for you. Revenues are finally above the pre-COVID levels. Considering that you've been growing at 30% plus on the top line for the last 4 quarters, what would you be targeting by the end of the year?
See, as you rightly pointed out, the key metrics are shaping up very well. The most important traffic, 171 million users, was up 16% year on year. And the good part is it has come at a very lesser advertising spend versus pre-COVID levels. Our collections last year were up about 44% year on year, which is translating into revenue growth this particular year. And this specific quarter as well, our collections were up about 28% year on year. So overall, while we do not issue any explicit guidance, things are looking quite optimistic for the rest of the year as well.
No, that is good to hear. I just want to maybe nitpick, but your active paid campaigns growth at 10,000 this quarter is lower than the 16,000 to 18,000 that we saw in the prior 2 quarters. Could you tell us what was the reason for that?
So seasonally, March tends to be the strongest month for us and April tends to be a bit weaker. That is what impacts sequential addition of paid campaigns. But overall, the way to look at it is that paid campaigns at 548,000 are at all-time high. And with the traffic trends shaping up, paid campaigns also should pick up growth in coming quarters.
All right, Abhishek, but can you put a number to that? Any guidance you can give on the active paid campaigns growth?
33% top line growth materialized as about 13 to 14% from paid campaigns and another about 18% from realizations. As we have maintained in the past, we would prefer revenue growth to be an optimal mix of both these parameters. So that way we expect sort of decent growth in both paid campaigns and realizations going forward.
Okay, so you spoke about realizations up 18%. Is it back above the pre-COVID levels?
Yes, definitely it is back above pre-COVID levels. And in last 2 to 3 quarters, while we have taken price hikes in specific geographies, tier 2, tier 3 cities have seen better price hikes because when we enter these markets, we enter with very entry-level pricing of say 750 rupees a month, etc. And there is significant headroom for these cities to catch up with tier 1 cities as well.
That is interesting to hear. Could you tell us what is the gap between tier 1 and tier 2, tier 3 realizations that you spoke about? And is there headroom to grow these realizations from where you're at?
Sure. So tier 2, tier 3 cities on an average basis are only about 40-45% of tier 1 realizations, which means potentially tier 2, tier 3 can even double up in their realizations. Overall, if we see our average ticket size is around, say, 18,000 rupees per campaign per annum, and 1,500 rupees a month is highly affordable for the kind of services that we offer. So not only in tier 2, tier 3, I think tier 1 cities too can see their realizations improve in coming quarters or years.
Well, Abhishek, what's the contribution of B2B? And I ask you this because recently there was a UBS note where they say B2B revenue contribution can go up to around 38 to around 40% over the next 5 years. As you continue, that segment could grow faster than the core business. Tell us about contribution from the B2B and can it get to those levels of 38 to 40%?
So B2B contribution was about 25-26% for the quarter in terms of top line. The good part is right now we are seeing strong growth / recovery in both the B2C and B2B side of businesses. B2B definitely holds great potential. It can go to 30% plus contribution in next couple of years itself. But the good part is that B2C also is seeing a great recovery, which is 3/4 of our business at this point of time.
So the operating leverage is leading to margin expansion. To what level do you think you can push the margins higher?
So pre-COVID, we used to be above 25% plus EBITDA margins, 27-28%. So this quarter, we were at about 14.9%. But with top line growing further and recent cost control measures that we have taken, we expect these margins to continue seeing sequential uptick, and we hope to take them to somewhere closer to pre-COVID levels by the end of the year.
That's interesting. So for about 15% compared to 25% pre-COVID, but you're planning to grow this. Now, cash at 4,000 crores plus. We ask you this every quarter, but we have to keep at it. The pile keeps on increasing. Any tangible plans that perhaps are in the works as a way to use this cash?
So we have about 4,160 crore cash on our books. There are no specific plans at this point of time. Part of the cash, as we have maintained in the past, could get used for any organic or inorganic opportunities, but no specific plans there. It's a good problem to have in my view, and in coming quarters, we will see what is the best way to be able to utilize this cash on books.
Okay, all the best. Thanks a lot for joining in. That's Justdial. Good numbers coming through, but the stock is under a bit of pressure. But now let's shift focus to the commodity market.